Milton Corey here, and today we're going to be discussing bonds. We have talked about stocks before, but just to give you a perspective, you may recall that when you buy a stock or you own a stock, you're owning a piece of equity in an entity, in a business, or whatever it happens to be. Well, when you own a bond, you're not owning equity. If it's a straightforward, simple bond, what you're doing is you are loaning money to the entity that issued that bond, whether it's a bank, an insurance company, a major corporation of some sort, or whatever. It doesn't make any difference. So a bond is a debt instrument. What do I mean by that? Well, let's say that your cousin comes up to you and your cousin says, I need $1,000 and I'll pay you 10% interest. And you say, well, okay. So you loan the cousin $1,000 because you think the cousin's a good risk. And when the cousin pays the money back to you, what happens? Well, you get the $1,000 back, which is the money that you loaned, plus 10% or $100. So you've gotten $1,100 back. So that's what you've done. You have literally, in this particular instance, loaned money to your cousin. What happens with corporate bonds or government bonds or whatever? Same thing. You're buying the bond, and really what you're doing is you say, okay, I'm loaning you, the entity, this money for a specified period of time. Typically what happens with bonds is that they have a maturity date. Almost all, of course all bonds do. So what that means is you might be buying a bond that has a 2-year maturity or a 5-year maturity or a 10-year maturity or whatever. Usually the shorter the maturity of the bond, the lower the interest rate is going to be. So what I mean by that is if you're buying, for example, let's use government bonds, for example. If you're buying a government bond and you're getting a 1-year maturity, the interest rate is probably going to be very low. It's going to be significantly less than if you buy a 20-year bond. And the ratio might be as much as 6 or 7 different times. So it might be that the way interest rates are right now, that you're buying a government bond and you're getting 2% on it because it's a very short maturity. But if you're buying a long-term bond, well, the return on that could be anywhere from, not the return, but the interest rate could be 6 or 8%. Which brings me to the question of return and total return on bonds as opposed to stocks. So let me try to keep this as simple as I can. When you are buying a financial instrument, you're looking to see what type of return you're getting on your money. Now, as most people would basically understand it, if you're buying a bond and the bond is paying 5% interest and you put $10,000 into it, you're assuming that you're going to get $500 on that every year, if that's the way it's structured. So that's very simple. Assuming that you've paid $10,000 for the bond and that you, when the bond matures, that you're getting your $10,000 back and that you've received 5% or $500 a year. Now it gets a little confusing. First, we understand now that a bond is a debt instrument where you're actually loaning money to someone or some entity, and you're going to get your principal back, and you're going to receive interest either periodically or at the time that the bond matures. Now comes the other part of the equation, which gets a little bit more confusing, and that is, what is the total return on the bond? Well, in the example I just gave you, if you're putting $10,000 into a bond and you're getting 5% interest, and at the end of time you basically get back your $10,000 plus $500 a year, what has happened? Well, you've gotten a 5% basic return on your money, keeping it simple. Now, to complicate it a little bit, let's say that you didn't pay $10,000 for the bond, you didn't loan the entity $10,000, you were able to buy that bond at a discount because of whatever factor, the market was uncertain, people were nervous or whatever. So let's say that you bought that bond for $5,000. Not 10, 5. So you've paid half. You've purchased the bond at a 50% or very, very deep discount. Still getting 5% on the $10,000. Now, wait a minute. I know I said 10,000 and 5,000. You've paid or loaned $5,000 for a $10,000 bond. Good deal, I would say, wouldn't you? Because now what's going to happen is, first of all, you're getting 5% interest on $10,000 even though you paid 5. So that means you're still getting $500. So what does that mean as far as what your investment was? Well, you're getting 10% on your money, not 5. Now comes the part that gets a little mind twisting as we get into the next step. When it comes time for that bond to mature, what are you going to get back? $5,000, which is what you paid for it, or are you going to get back $10,000? Well, the answer is quite simple. If you hold that bond to maturity, in other words, the date that it says it's going to pay back all of the people who loaned the entity money, you're not going to get $5,000 back. You're going to get $10,000 back. So now, wait a minute, now it gets a little confusing, doesn't it? Because you've been getting your $500 a year on your $500 investment, on your $5,000 investment. So that means you've been getting 10% on your money as you go. And now, when the bond matures, that $5,000 you paid becomes $10,000. So what is your total return on that particular purchase of that bond, or that loan if you want to call it that, but really it's a purchase? Well, you've gotten a 50% increase in your money. So depending on how you look at it, you've either made 50% on your money or you've made 100% on your money, whichever way you wish to look at it. But on top of that, you've also gotten, instead of getting 5% on $5,000 or $250, you've been getting $500 a year. So what is your total return on that particular bond? And believe me, people stand in line to buy these all day long when they can find them, and they don't happen very often. Well, your total return on buying that type of deep discounted bond, which is the term deep discounted bond, the total return on that turns out to be well over 50%. Super. Or 100% if you depend upon how you look at things. It is that part of it's confusing. We'll get into that in another discussion. So the question really is now, as we've talked about a bond, which you understand is a debt instrument where you're loaning money to an entity, whether it's the U.S. government or a foreign government or a corporation or whatever, and you're getting an interest on that, and then you're getting your principal back. So the difference between stocks and bonds, again, a bond is a debt instrument. In other words, that's a loan to some entity. While stock is equity. You're actually buying a bit of a piece of a corporation. And I'll go into total return on stocks at another time, but the concept is basically the same. Your total return is calculated based on what you paid for something, whatever return as far as interest or dividends you received on that during the time that you owned it, plus what is the dollar amount that you receive back at the time that you sell it. That's total return, regardless of whether it's a stock or a bond. It does not make any real difference in that particular scenario. You know, if you'd like to know more about the difference between stocks and bonds, or if you'd like to know more about stocks or more about bonds or more about other investments, simply look on the Principal Truth website. You'll find links there that will take you to various explanations of all of these different things, and also to entities that can provide you with services that are related to either stocks, bonds, or mutual funds, or whatever it happens to be. If you look at our site, you'll find it's quite interesting. There's lots of different things there. That is Principal Truth, www.principaltruth.net, principaltruth.net. Take a look at it. You may find something of real interest there. My name is Milton Corey, and this is Principal Truth. And please go on the website and listen to some of the other segments. God bless you.